can I just start?
Yeah.
Are you ready?
Yeah.
All right, rather than you ask me a question.
This is great.
Because before we went on camera, you just said, and a fool is a good thing. And you just triggered a thought that the experience of writing this book has sort of hammered home. And it's that a big part of the problem in the stock market right now, or has been, that investors did not want to acknowledge their ignorance about how the stock market worked. So they're willing to believe the noise that came out of brokers' mouths about how electronic trading worked. And everybody is still, to this moment.
And not just investors, like small investors, but like the CEOs of large mutual fund companies.
The heads of mutual funds, the heads of pension funds, the big hedge fund managers, that the thing that they get quickly offended by, coming out of my mouth, say, is the idea that the hero of my book explains to them how the stock market now works, even though that's what happened. That 2 or 3 years ago, they had no idea how they were being front-run by high-frequency traders. This guy comes and explains. They respond by saying, oh my God, I can't believe this is happening. Flash forward to now, and when they tell the story, oh, I knew most of what was happening. He helped me round out my understanding. And it's funny that it's a problem in finance. And I don't know quite why it's a particular problem in finance. The idea that ignorance is a sin, and so everybody's terrified about not knowing, when it's such an unhealthy
I'm not defending finance by asking this, but what industry is ignorance not a sin? I mean, obviously, it's maybe the greatest sin in finance, where you're essentially, in many cases in finance, acting as salesperson.
I have an answer for you.
Yeah.
My industry, journalism. It's great not being a detective. Columbo, you know, that not knowing is an excuse to learn. That not being a know-it-all is a huge advantage in being a journalist. It's better to seem to know less than you know.
Have you read the book The Outsiders by Will Thorndike? Is that?
I have not.
Okay, this is a. I've read this. You haven't, so I get to sound smart momentarily. But what Will says is that what Will says is that he points out 8 CEOs that performed incredibly well over 20+ year periods as CEOs, and he looks for the patterns across them. Right. And what he finds is that virtually all of these CEOs came from outside their industry, so they acted as detectives. They had to figure out what was really happening. They brought fresh eyes to it, and they didn't have any convention to protect.
And there was no stigma associated with not knowing.
Right.
And there's this stigma associated with not knowing things in a rapidly changing environment, which is finance. So things are always not known. There's all this innovation going on, much of it malign. And I mean, nobody knows what a subprime CDO really is, or whether it's really AAA. Nobody asks. I mean, so that's. I don't know why this is particularly a problem. I think it is a particular problem.
Oh, yeah,
it's very noticeable in finance, and it may be because in finance it's filled with people who are rich and they're used to people thinking they know everything, and they like that pose of I know everything.
Well, it creates an incredibly interesting dynamic now that technology is coming front and center into finance, and of course into every industry.
And nobody knows anything about
algorithms,
that. Right.
And what 61-year-old CEO of a large financial firm should know things about that going in. And so they're seriously hurt by the fact that they can't willingly admit that they don't understand how the tech works.
So I'll tell you a quick story I heard. I didn't put it in the book while I was working on it. So a guy who I met who kind of experimented in designing high-frequency trading strategies, but it never really put him into practice. He was a professorial type. Collided with an old trader who ran a money management firm who said, this was 5 or 6 years ago, let's try your algo. Let's go trade with the thing you dreamed up. And so the guy says, I've never done it before, but let's do it. So they said hook it up, so they're hooked up to doing trades. And they hit the button, enter, to go. And the thing starts doing maniacal things. I mean, it's like losing money. And
it's like an IBM commercial right now.
And the 61-year-old CEO of the money management firms, turn it off, and they can't, hitting buttons and they can't turn off. He goes on and he yanks the plug out of the wall to shut the machine down. But it was just, it is sort of like the mark of the Wall Street man, overconfidence. I mean, male overconfidence is responsible for so much trouble in the financial system, and when it collides with technology, it's particularly toxic, I think.
Let's go with some of the basic themes of the book, just for those of us who aren't familiar with them. And I was saying to you off camera that high-frequency trading, dark pools, the whole dynamic between the two, flash trades. I've heard the terms, but I've never really spent much time digging into them because I'm buying stocks and holding them for 5+ years.
So there's no particular reason for you to know.
Nonetheless, it would be good for me to know, and now
for one reason. You know what the reason is? That you're talking about the structure of the market you're operating in. So you may, well, you just sitting on stocks may not be getting scalped that often. The market is becoming increasingly unstable in the service, just to serve the high frequency traders. And
flash crash.
Flash crash is just, it's one symptom, but you know, outages at NASDAQ, BAT's IPO going crazy, Facebook IPO, it's one thing after another. So at some point, you have to pay attention. You shouldn't have to, but it probably behooves you to pay attention to, is this market stable?
So what is high frequency trading?
It's a term of art that really didn't hit the newspapers or the public consciousness until maybe 2009, when a Goldman Sachs programmer was labeled a Goldman Sachs high-frequency trading programmer, was arrested by the FBI for taking Goldman's code, and it's not easy to define. I guess you could say, if you want to be the loose definition, it would be trading by computer algorithm at very high speeds.
Microseconds.
What's a microsecond? I mean, right? I mean, it's milliseconds. I mean, in fact, at this moment, the cutting-edge high-frequency trading firms are talking about picoseconds, and which is worse than nanoseconds. And so, to put that in context, I'm told that a blink of an eye takes between 100 and 200 milliseconds, and a millisecond is 1,000. There's 1,000 microseconds in a millisecond, 1,000 nanoseconds in a microsecond, and 1,000 picoseconds in a right. So it gives you an idea. I like to think I can blink my eye faster than that. See, I did it.
You are ready to trade. You are ready to trade.
I'm ready to go.
So talk about spread networks, and that essentially, in a way, as I was reading, I was thinking this is like the very first oil pipelines. I mean, maybe not necessarily
the railroads.
First. Yeah, I was. Yeah, go.
Railroads. So can I frame this just by saying?
Please.
All right. So the book it's a very simple structure. It's about one guy who's a trader on Wall Street figuring out how the stock market actually works. Even though he's in the stock market, he realizes around 2008 something's changing. I don't know. What is it? And spread networks enters in the story, even though it opens the story, as an important data point for him in what's happened. So what spread networks is there was a trader on the Chicago Mercantile Exchange who realized that people were willing to pay for speed, incredible speed, but without totally knowing what it was for. His name was Dan Spivey. And Spivey in 2009 looks at the fiber optic line that runs from the Chicago Mercantile Exchange to the New Jersey stock exchanges where the actual stocks are traded. Futures are in Chicago, individual stocks in New Jersey. And he sees that the fastest line goes like this from one place to the other. It's a Verizon line. It takes like 16 milliseconds, which go back and forth, which is not much time. But nevertheless, he realizes if you just laid a straight line fiber from the exchange to in Chicago to the exchange in New Jersey, you could get it down to 11 milliseconds, and that whoever was faster was going to. Winning by a microsecond was enough.
And people were already trying to capture good areas of the Verizon line.
That's right.
And Verizon didn't even know what they had. They didn't realize that
they
people were using it to trade.
They didn't realize just how valuable very small increments of speed had become to stock market traders. And he did. He didn't know exactly how either. In fact, he was flying blind in a lot of ways. But he persuades Jim Barksdale, who is the former CEO of Netscape, and some other investors, but mainly Barksdale, to give him $300+ million to dig a hole, to dig a tunnel from Chicago to New Jersey on a straight line to lay this fiber, completely in stealth. He is able to string this line through. Pennsylvania turns out to be the problem. You can lay it. It's pretty easy to run a straight line through Ohio, and but when you get to Pennsylvania, mountains are the problem, and the mountains run kind of diagonally. So he blasts holes through mountains. He he goes through farmers' fields. He goes through parking lots. He buys rights away.
What year is this?
2009, 2010. So not that long ago, right? He finishes it in the summer of 2010. He's able to do it without anybody asking him what exactly is the line for, or at least not having to answer the question. That people just, well, it's just some fiber. And the sole purpose of the line is to speed up stock market trades. And what it's really supposed to do, I mean, I don't think even he completely got this, because he thought he was building a line that enabled people to do the arbitrage between the futures and the cash, you know. But the way the high frequency traders work is they're making lots of little markets in small amounts of shares in all the stocks in New Jersey. They don't actually want to own these things. They're trying to tease out information. They're making the markets to tease out information about what investors are doing so they can react to it.
So they're listing 100 shares available
on either
when
side.
An order is coming for 10,000
Right,
shares.
so they find, so I want to get on the other side of that. I want to get in front of that. But with the risk, the big risk for them is that the whole market goes down, and they're sitting here dangling out 100 share orders in 4,000 different stocks, and they get hit, and they'll own a bunch of, they own, you know, all that stock. So they are very sensitive to overall market movements. They need to know market popping, market not, and the market popping and the market going down first registers in the futures in Chicago. So they get the market direction, the directional signal from Chicago to New Jersey. It says get out of the market. You know what happened in the flash crash? My guess is, it's not been well explained, but my guess is that's how it starts. It's someone that it does start in the futures market, and then the next thing is all the people who are supposedly the intermediaries in the stock market just pull out.
But if that's the case, I don't want to digress here because I like the thread here, but is it possible that people should be, these players, whether they're good or bad actors, shouldn't they be building their systems closer to the Chicago futures? Shouldn't they be getting the quickest possible read there rather than in New Jersey, or they're doing both?
Both.
Okay.
Yes, they're doing both. So and this line gets the signal in the fastest possible way from the Chicago exchange to the New Jersey exchange. So Spivey, the great thing, I mean, there's several great things about this story. So because he does it completely in secret, he doesn't tell any high frequency.
It's also great that he's doing it in secret and he doesn't really fully know why he's doing it.
He doesn't. He thinks he knows why, and he thinks he knows the market. He thinks there are 400 people out there who will pay. He's guessing $10 million a pop to be on the line, but they're guessing. I mean, there's this wonderful business school case study that someone will do about this one day, but. So they start to go out into the market to tell high-frequency traders that if they want the fastest line, he's got it. Just flip it in on a week. You better pay for it, or you're out of bit, or you're not. You're going to be last to know whether the market moved. And the high-frequency traders, when he goes to see them, they're like, "Who the hell are you? You know, they don't know. What did you just do? $10 million? You out of your mind? We have basically like a costless line already from Verizon, and then nobody knows how valuable it is." And so they really want to like throw him out of the office, but then they realize he's right. We got to have it, but it isn't 400 of them. It's 27 of them. It's not that many. But
in a funny way, they also begin to resent him.
They hate him.
Yeah,
they all hate him. They all hate him. He didn't
my
care.
system is working now. I'm gonna have to pay $10 million, and now the game is on to go faster and faster to beat the other firms.
Right. They hate him, and he loves it that they hate him. He doesn't care. He's like the salesman who doesn't matter what his customers think about him. And he says this to me actually. So it was kind of fun to see how angry they got. One of the customers, when they walk in, gets angry, calms down, says, "Let us think about it," and then comes back and says, "Can you double the price?" Because they wanted to price everybody else off the line. The bank's response is riveting. So he goes into the banks. The banks are trying at that point in their lives, think they're competing. I think they think they're going to compete in high frequency trading. That turns out not to be so, I think. But he goes into Goldman Sachs, and he goes into Credit Suisse, and Credit Suisse says, and he says, you can at least for $10 million you can be on the line, but you can't let your customers use it. You can't let anybody else use it just for your own proprietary trading. To which they say, screw you, you're trying to screw our customers. We won't do that. You want us to trade against our customers at a faster speed than the customers can trade. It's going to look, we're not going to do that. He goes to Goldman Sachs and they say, ship it in, we'll take it.
And I also like the Morgan Stanley.
And Morgan goes to Morgan Stanley and they say, could you change the language? Because we want to do it. Yes, in case we're called out. So the optics aren't good. But he starts to develop the first picture of what this market looks like. No one knows this market. No one knows who these high-frequency traders are. He's finding their names in kind of obscure SEC documents and calling them up out of the blue and saying, you don't know this, but you have to meet with me. So that's, the book opens with this project, and it is...
In a funny way, Dan Spivey is similar to Brad and Ronan in that when they went to present what they were developing, it's Moneyball. They were laughed out of the executive suite at every baseball team stadium. It's very funny. You know, my brother David, initially, he wanted to go into baseball. He thought there was no path for him, having read Bill James so early on. Right. I don't know when Bill James first started writing, maybe in the early 80s or something. But Dave was there reading Bill James and in the late 80s and really wanting to go into baseball and felt he would never have the ability to do it, so he went into investing because it was a meritocracy where, hey, people can laugh at me. They can say that my strategy doesn't work, but
I have the result.
The merit will out. Yeah, right. We'll see what the results are. And so you have these characters who are stepping in to, the executive suite and convention and being sort of initially laughed at before they explain why it is what they're doing and what it will mean.
So here's also how it's very similar to Moneyball. So the Oakland A's go and find, basically with their actions, say to the rest of baseball, you don't know how to value baseball players and you don't understand the value of baseball strategies because we found inefficiencies in them and we're exploiting them, and that's how we're succeeding. And the book describes that process. And it, in the bargain, embarrasses everybody who's not doing it their way and creates this uproar and this anger. Brad Katsuyama and IEX come out and say, we have created the only fair exchange where investors actually are on equal footing and there aren't people exploiting each other just in the structure of the exchange, thereby embarrassing and humiliating and shaming all the 13 public stock exchanges and 46 dark pools are out there, and basically everybody who's involved in the stock market, and creating a very similar sort of uproar. And it feels, this book feels, in the experience of publishing it, very similar to Moneyball.
You know, it's interesting because there's so many other things I want to cover. I know we have limited time, but Dan Spivey, there's almost a little Moneyball in that. I mean, he's seeing something that others aren't seeing.
It's an unbelievable act of entrepreneurial nerve to say, I'm going to lay a straight line from Chicago. I'm going to dig a tunnel.
I'm going to blast through the Allegheny Mountains.
I'm blast through the Allegheny Mountains, and I'm going to do it completely in stealth. No one's going to know, and I'm going to spring it on a market I don't even know.
But then what it creates is bad actions. That use of the technology, that great new insight in active entrepreneurialism leads to something that you certainly, I think, from the tone of the book, don't favor.
So here's why.
And Brad counters it.
So let me just, I have a thing I got to kind of square in my head, and it's this. So I think Spivey's entrepreneurial act was incredible. I mean, it's like, this is what makes America great, that someone's willing to go do that. And at the same time, the use to which this thing is put is not great. But I would say this, that the high-frequency traders were always going to have the fastest line. They were going to be doing this. I don't think he increased the take that high-frequency traders have in the market. He just taxed them. It's almost a pure tax. So in a way, it was kind of charming. He was bleeding the profits of high-frequency traders. It's like someone who sneaks onto the pirate ship and steals the pirate's stolen gold. That's what it feels like.
So you know, I think a lot of people, myself included, initially thought high-frequency trading was profitable because of speed, and that was it. That they had some.
Why would speed be valuable all by itself?
I was going to combine it with that they had their beliefs about where the market was going based on their fundamental research. Right? Yeah, right. So I'm a fool. I don't feel uncomfortable being laughed at.
That's very sweet.
This is why this book was so valuable to me, Michael.
It's very good.
I didn't know what the high-frequency trader advantage was. They have speed. They're there first, but what if they're wrong?
So couple this with two things. One is their obsession is with speed, right? With microseconds advantages. And two, the fact that what we know of them, they never experience a day of trading losses. That every day is profitable. 1,000 days of no trading losses.
Mathematically impossible unless...
So how does that, unless you're basically gaming a market, unless that is not, there's no, you can't be taking market risk. You can't be making judgments about stocks. No matter how good you are as a money manager, you will have stocks that go down some days, right?
Of course.
Of course. So they're doing something different.
Oh, well, this is why this book was so valuable to me.
Yeah, no,
and what they're doing is explain dark pools and what is happening with the various firms.
So one of the things the book tries to do through the journey of Brad Katsuyama is divine the different predatory strategies. I don't pretend to have gotten them all. He finds 4 big ones. So I'll give you an example of the one that's easiest to sort of get your mind around. Is the first one he discovers. He's sitting at his desk, at his trading desk in southern Manhattan in 2008. Previously, before this, he starts to notice something is wrong. When he would look at his trading screens, he'd see however many stock markets there were at the time. He'd look across them, he'd say, well, all together in all the markets, there's 20,000 shares of Microsoft offered at $25 a share. I can buy, and if I want to buy 20,000, he hits a button, I'll buy 20,000, he gets them at 25. He would just get them. One day he wakes up and he hits the button, and he only gets a couple thousand. Like everything else disappears and Microsoft stock goes up. And he realizes that from then on, every time he hits a button to buy or sell, it's like the market knows what he's trying to do and runs out in front of him and either jacks the price up or sends it down, depending on whether he's buying or selling. It takes him a year and a half to figure out what is happening in this.
By the way, how much do you think it's moving up? Let's say 25 pennies.
Pennies.
So he's putting in his buy at 25.01.
But over the course of a year in his trading desk, it's
yeah.
tens of millions of dollars. So it takes an incredible act of sort of detective ingenuity for him to figure out what actually is happening. And what actually is happening is one of the HFT strategies is his signal from the buy signal from his desk goes up the side of the West Side Highway in fiber optics, goes out the Lincoln Tunnel in the fiber optics that are on the side of the Lincoln Tunnel, and arrives first at the BATS stock exchange, which is planted right on the other side of Lincoln Tunnel. I don't know why it was built there, but it's interesting that it was built there. The other exchanges are further away. It takes his buy signal longer to get to those exchanges. On the BATS exchange, high-frequency traders are making small markets in Microsoft to divine the intentions of brokers who are sending in orders. They divine his intention to buy Microsoft, and they race him and beat him to the other exchanges, buy up the Microsoft, and then sell it back to him at a high price. So that's what happens in that case. And every time it's
parasitic.
It's parasitic. No matter what exchange he landed in first, they would beat him to the other exchanges to get whatever stock was there. So the fragmentation of the market created this opportunity for people to race back and forth between the markets. And the dark pools add even more fragmentation. So it's the one way to kind of generalize what's happening is that sort of like there's 60 places now where you can buy and sell the stock of Apple or
for investors, let's say for large investors who don't want the market to know what investment they're making. So they send their order into a dark pool.
Well, which ends up not being a dark pool.
It's like, by the way, we put a couple flashlights in the dark pool and we've given bathing suits.
That's exactly right. So they've given flashlights to high-frequency traders in the dark pool. They've given them special access, sold them access to the dark pool. And then what they do is the way the big banks tend to route the orders is it's like they want the order to be executed in their dark pool. So they do everything possible to prevent it from being executed outside the dark pool. So they hoard the orders. So they keep big orders that might cross away from each other. So buyers, this system of intermediation has evolved to prevent buyers and sellers from coming together too easily, because otherwise you don't need the intermediary.
So people are saying, I'm sure it's happened in some of your interviews, I know that I've read online, some people are saying, well, this is just great. I don't know why Michael Lewis is raising an alarm here. This is creating a tremendous amount of liquidity in the market. It's allowing investors to be down penny to penny rather than back in the day in 1989 when I was buying shares. It was like you could buy it at 35 1/8 and this, or it's 35 1/8 to 35 7/8. So I mean, we're not talking pennies. So we're out of fractions. We're into decimals. And
so people are saying this. People are saying this. So let's see if I can explain this. So technology has brought wonderful gains to many industries. When I was living in London, when I was 24 years old, it cost me like $2 a minute to make a phone call to my parents. It now costs me, whatever, pennies a minute, right? Now, so imagine, and that's because of gains in technology. Now imagine if some gremlin in the middle of the telephone system, in the process of that declining price. Instead of letting it go down to 2 or 3 pennies a minute,
wedge
its way in and charge me 10 cents a minute or a nickel a minute. I'd say, wow, the phone system's still so much better. Why am I upset with the gremlins?
And they were the first ones to go out publicly and say, we're creating
phone calls.
So we're creating voice, sound at a lower price.
So let me give you another explanation to couple with that explanation. If you take any market, take a stock market, if the government waved a wand over and said, so you now have to be front run. Here's the government entity that will front run
Scalpers Inc.
Scalpers Inc. will front run every trade. What is the effect on this market? It will double the volume in the market because every trade gets front run. So all of a sudden, the Scalpers Inc. it creates twice the volume. And if you think liquidity is volume, yes, you increase liquidity, and you can start to say you can't get rid of Scalpers Inc. because otherwise the market would be half the size of the. That's what's happened. So you have to define liquidity. What is liquidity? It's your ability to turn your stock into cash. They're not there to do that. They're not there taking risk. They go home every night without positions.
Without them, technology and decimalization, the spreads would be narrower.
That's true. The actual spread will be narrower. I mean, the stated spread is often a penny, right? It's tiny, but it's not. It's an illusion. The minute you go to act on that spread, it widens with any volume.
So, what has this changed for you in your active day trading?
I don't.
Well, that's my question. What impact does this have on your approach to investment in Motley?
Can I just tell what my reaction? So my reaction was, first, unbelievable story that this has happened and that these guys went and figured it out. So that was my first reaction. But how it affects me personally as an individual investor. I am the most passive investor there is. I take very little interest in it. I don't trade and I hold long term. And so the scalping side of things matters very little to me. I mean, I'm not losing that much money. However, this is a system-wide tax on investment capital. And I don't know what it is. It's 20 billion or 30 billion, whatever it is a year. It's a significant sum of money. So that's bad for the economy. Productive enterprise pays more for capital because of this. Now, that's in a way trivial compared to the instability caused in the system by the complexity required by high-frequency traders and imposed on and demanded of the exchanges by high-frequency traders. So what is the instability? What do flash crashes and NASDAQ outages and all this lead to? It leads to mistrust in the investment public. Why on earth are fewer Americans, is there a decline of individual American investment in the stock market during one of the greatest bull markets in history? It's because people don't trust it. I mean, there is understandable mistrust of this market. It's an unstable market. So what's the cost of the mistrust?
Well, here's a funny dilemma. I mean, I don't want to put you in the position of being incredibly selfish, but I'm going to for the fun of it. Doesn't all of that actually benefit you as a passive long-term investor? I mean, I don't want to make it all about each of us as an individual, but if so much of the financial machinery and the people that are behind it, which are becoming fewer and fewer as the machines take over, is focused on trying to slice down the time and the frequency that they can activate trades and the information they can get to just nibble and be a parasite on every transaction. There's so much attention there. Doesn't that open up and if the rest of the marketplace is therefore distrustful, doesn't that create a great long-term opportunity for a long-term passive investor like you?
I have to think about that one. I mean, I think that I'm
not saying it's a good thing.
No, let me just. So my reaction, my basic reaction is probably not, because what I'm thinking is, all right, I'm a long-term passive investor. What am I actually doing as a long-term passive investor? I'm making an investment in the future profits of American corporations, or the corporations in my portfolio. And those future profits are going to be badly affected by an unstable market if they're operating in an unstable market. I mean, it's just not good. So, but as a stock picker, if I was a long-term stock picker, maybe it creates more. If fewer people want to be in the marketplace, maybe it creates a bargain or two for me. I don't know. I just don't know. But I don't.
But the overall instability and loss of trust in the market system.
So can I add one more thing as a cost? And I don't think it's trivial. So if you create an industry on Wall Street that sucks in the best and the brightest, whose job is basically to game the system and scalp investors, and you create that as a model for success in this country, and like that's what kids who graduate from Princeton, Harvard, and Yale think is successful, what is the effect of that instead of doing something actually useful?
I love the description in the book of, I think it's John Schwal, his first name John?
Yes.
Schwal. And he's assembling the LinkedIn networks to understand what's happening with high-frequency trading businesses, because none of the executives will go on record and they'll fire anyone if they speak in the media. But so many of the developers, the software developers, the technology are going onto LinkedIn and posting what they do, and he's able to connect those networks and read what they're doing, and he comes to the conclusion that all of these very bright, presumably very bright developers don't know, they don't have any idea what they're doing. They're building the whole technology platform. They have no idea how it's being used. It's being used to parasitically nibble off trades across the market.
Right, that's right. It's amazing, and they found this, the people at IEX found this over and over, that the technologists tended, not always, but tended to be so narrow, so specialized, that they didn't have a sense of how their work fit into the big overall picture. That's a real misuse of talent and resources. So that's disturbing.
I have a potential solution. I'd like to have you shoot it down. Because I can't shoot it down in my mind right now, but I'm sure it can be.
Maybe you can't shoot it down because it's your solution
and
you really don't want to.
I'm so egotistical.
Okay, but I'll try.
So here's what it is. Why don't we apply capital gains tax rates tied to the length of your holding period? We do in a very generic macro, like in a very
you're saying if it's a millisecond.
Yes, it's 98% capital gains tax, and basically if it's 10 years, it's 0% capital gains.
So here's the thing. I mean, this is going to sound crazy coming from my mouth right now, but I have no doubt that there's some useful high frequency trading, and if you start mucking around in the markets that way, I think what we need is more transparency about what's going on. I think there are other ways to solve the problem. That seems like, I don't know what the consequences.
It seems so great
I don't know what
to
the
me
consequences
that everyone now needs to be in New York. I love the firm. I can't remember in the brilliant story that you've told here, the firm that feels like it's fine to be in Kansas.
Yes.
And then they're waking up to the reality.
Well, you remember? You probably remember. There's a time when people were saying that the great thing about now, the technology means it doesn't matter where you are.
But if everyone needs to converge closer and closer right into the center of New York City, and New York City has like the highest tax rates, why don't we tax that for high frequency trading? They really have to be in New York.
Well, they have to be in New Jersey, which is even worse.
They have to be in New Jersey.
They have to have their machines next to the stock exchange. That's the thing. Wall Street is no longer Wall Street. It's in New Jersey. And how that happened, I don't know.
Michael, what do you think broadly is happening with technology and like algorithms, robots? Does this interest you, or do you just happen to have gotten deeply into the story because it's in the world of finance, which you have spent so much of your
I'm probably not as interested as I should be, but you can't help but notice that the technologist is displacing the trader on Wall Street. I mean, that's what's been happening, is machines have replaced people. So the people who control the machines are the people who have increasingly power, people who understand the machines. So it is.
So the Russian technologist who's in jail, rightly or wrongly now.
They let him out, but yes.
Okay, they let him out.
His conviction was overturned after he spent a year in jail.
Okay. So, but those technologists, you're saying, they are the future of Wall Street. Like Pixar is the future of Hollywood in some way. I mean, technology that may be a backroom basement tool that has been used by investment firms is becoming much more front and center, and ultimately will be the leader of those firms.
So I think one of the reasons the high frequency trading industry, this shadowy, very small firm kind of industry has flourished, is that the big banks did not confer enough status on the technologists who could create high frequency trading platforms, and so that they went and did it outside the banks. They don't respect the technologists. So I think that's probably changing, but slowly. And I do think that, I mean, the geekification of Wall Street started when I was there. I mean, that all of a sudden the Salomon Brothers trading floor, the guy who used to be the guy who ran the thing was big and hairy and ape-like kind of thing, and he got replaced by these weedy MIT guys who had no hair anywhere.
Does this cause you to be a long-term optimist about the markets and market stability, and do you believe that the book has the potential to have a major impact? I mean, I presume that's part of the reason you spent probably a very intense period, given how recently this happened, to actually sit down and write this book. Are you an optimist that things are going to be, transparency will win, and that the market will be more stable for investors?
I think it's going to be a war. I really think that it's going to be an ugly, long war. And I think that Brad Katsuyama and IEX, I think Brad Katsuyama is Frodo Baggins in Lord of the Rings. I think he's sort of like, he has antagonize Mordor, and the orcs are rising on Wall Street. And on the other side, he's got this Fellowship of the Ring thing with investors, big investors who are supporting him. And the war is between, ultimately, big investors who manage little people's money and the system that is exploiting the money. And I don't know where it ends up. I don't actually know where it ends up. I do think it's not going to just go away quietly. It's not, the book's not going to be published and then people are going to forget about it because they've got all these investigations going on. And I do think also that if the world changes, it won't be because of the book. It will be the people, but IEX could be the lever. That you create this fair exchange. It really is, and it's really a fair exchange. And you're committed to restoring trust in the financial markets. What you do is you give people a choice. And so all of a sudden they're making, it's not one dark pool versus another, or one exchange that's sold out to HFT versus another exchange that's sold out to HFT. You actually have a fair place that's operating in the interest of investors, that you force a choice onto the world that hasn't existed before, and that's very seditious.
So already an opportunity to have a purely transparent.
But yes, there's no reason it can't be. I think there's no. So I do think, I think they're going to win. I don't know how, but I do think. I mean, I can imagine several paths to change. I mean, I can tell you what I think the most likely is. The most likely is one of the public exchanges, possibly the New York Stock Exchange, says it's actually, this thing is turning fast. The old business model of deriving our revenues from high-frequency traders is going to collapse. Let's buy IEX and make them the New York Stock Exchange.
Let's get the reputational win.
Yes. And
huge reputational win.
So Goldman Sachs has been the first mover in the banks to get behind IEX, and no one else has followed.
I love that part of the reason that could be true is because they realize they can't catch up technologically.
That's right.
So they're like, that's your point. Let's play the reputational side.
Let's play the reputational side.
Let's win with what we have.
So there's no reason an exchange, one of the exchanges won't do the same thing, and that would the natural one to do it is a New York Stock Exchange.
Michael, I know, by the way, so in that scenario, you are our J.R.R. Tolkien. We hope you're safe out there writing about this.
I thought it was Gandalf.
Okay, you're Gandalf. I love that, but you're such a youthful Gandalf.
Okay, so, I'll be one of the humans. You know, one of those guys. I'll be Viggo.
Okay, perfect. You're Viggo. So I know you're not going to share this with us. This is the final question I'm getting from Mac, our producer, that you have to go. You've got another variety of interviews here in New York, so thank you for spending time with us. Federal Communications Commission license number 1215095. I Googled it. I need to dig deeper.
You do.
There's a clue. Has someone figured the mystery of the final page of your book out?
Not someone who's going to put it in print, but an investor got to the bottom of it very quickly.
Okay, got it. So do you have any additional clue or hint for us, or no, we're on our own? There's enough there.
There's enough
there.
That
investor did it.
You can figure out who did that.
There's a puzzle at the end of this great book, and we're going to figure it out together in the Motley Fool One community. Why not? Michael.
Thank you.
Thank you.
It was fun.
Yeah.